All right, in this lesson, we are going to go over a deferred expense. We'll talk a little bit about it, and then we'll go through a couple of examples at the end of this so that you kind of know how do we approach it and what is actually going on from a journal entry standpoint. So let's get started here by talking about some basics. So some of the basic things that you should already know is that all of the rules for journal entries apply. So debits must equal credits. Debits go before credit. So everything that you know about journal entry should still apply in this section. Now, we also are going to still use this expanded equation for debits and credits, where you're going to see less and less of this throughout the entire course, primarily because at this point you should have a good handle on this, so you won't see this much on your screen here, but that's going to be an important part here on the debits and credits side. All right, so what are we trying to do with deferred expenses? Well, deferred expenses, we're saying that, the account looks like the one on the left-hand side right now. So $4,000 is what we have in the account. After the expense is incurred, that deferred expense account needs to come down to a level where we've removed what we've already used. So the difference between what the account is now to what it should be now is the actual adjustment. So that's what we need to adjust. We need to adjust this deferred expense down by, in this case, $2,000. So that's what we're trying to do here with deferred expense transactions and adjusting entries. So let's review some of the mechanics that we learned in the last lesson. In a deferred expense, we are paying for the expense up front. Cash is being paid now, but the expense will be incurred later. Now, when we say cash is incurred now, or is paid now, we're assuming that we're paying the cash now, which is not an adjusting entry because it involves cash, but that down along the road here, the expense will be incurred, and that's when we're going to book the expense. That's when we're going to book the adjusting entry. So a deferred expense adjustment is made to move the amount from a deferred expense account to an expense account when the expense incurs. So I always like to look at these of, what is going on. Give me the context. So the original entry might look something like this. So the payment of the cash would have looked something like this from a journal entry standpoint. We would have debited a prepaid something expense. Now, we don't usually use an account called deferred expense, so you'll see something called prepaid. So that's kind of just to know that. So we'll debit a prepaid expense, and then we'll credit cash because cash goes out. And then what do we get in return? We get a promise of a future expense happening, okay? And then the adjusting entry looks like this. We're going to reverse out this prepaid here. So to reverse it, we do opposite. So in this case, we had a debit. To do the opposite, we have a credit. So we'll credit the prepaid, and then we'll debit the actual expense, whatever it might be, utilities, insurance, rent. That would be the expense that we would book. So that's how we would do it. Now, it's important to note here that this amount here does not always correspond with that amount there. So just because we might have debited prepaid rent expense for $1,000 doesn't mean that when we make the adjustment, that adjustment will also be $1,000. If that $1,000 covers 2 months and we're only adjusting for 1 month, we're only going to have half of that $1,000. In that case, it would be $500. So it's important to know that there could be a difference here in those amounts, okay? So with that being said, let's take a look at an example here. At the beginning of the period, Walnut Creek had $825 in supplies. At the end of the period, the accountants counted all the supplies and only could account for 220. So we had 825, and that's pretty much what the books would have said. The books would have said we have supplies of 825, but when we counted them, we only found 220. So the question there is, what happened? Well, we must have used some supplies during the month, which means if we used them, we actually incurred the expense. If we incurred the expense, we now need to adjust for the expense. So that's kind of what we're getting at here. Prepare the adjusted journal entry to recognize the supplies used during the month. So from a visual standpoint, this is kind of what we have here. This is what we have in our books right now, 825. When we counted everything up in its physical locations, we could only find 225. So our supplies accounts needs to be at 220. Our supplies need to be at 220, not 825. So we have a difference. What is that difference? Well, that difference is the space here, which is represented by $825 minus 220 gives us $605. So what we're saying here is we've got $605 of supplies that are missing. Now, nobody stole it because nothing in this problem said that they stole it. So the only other assumption is that we use supplies of $605. So we now need to make an adjustment to get the supplies account from 825 to 220. How do we do that? We make an adjusting entry of 605. So the difference here and here is 605. So we need to make an adjustment for $605. So let's just go through this here. So I've got the T account on the lower left-hand side, and then we've got some journal entry lines here. So the first journal entry line that I wanted to show you, which is not an adjusting entry, so this would have been the original entry. So the original entry might have looked something like this. It would have been debited supplies for $825 and credit cash for $825. So this is not an adjustment. If you see AJE, that means adjusting journal entry. So that's the shorthand. So AJE. So that's not the adjusting entry. So that wouldn't be the answer. But I want to, again, show you the context of where it's coming from. So when we do that entry, the T account now shows 825 as shown on the lower left-hand corner. Now, the adjusting entry. So what is the adjusting entry? Well, it's showing this supplies account is showing at 825. Where do we need to get it down to? We need to get it to 220. So it needs to get down to 220. Well, the question is, how do we get it to 220? Well, we need to bring the supplies from 825 down to 220, which is a $605 difference. To do that, if we increase the supply, we would debit. So to do the reverse, to bring it down, we would credit supply. So I'm going to credit supplies for 605. Okay, so we're going to credit it because that is the opposite of what we do to increase the supply. So if I did that and I just go to the T account, that 605 is on a credit side, so it would go on the credit side of the supplies. Well, the question is, does this T account make sense? Well, 825 or bigger minus smaller goes on bigger side. So what's the bigger side? 825. What's the smaller side? 605. So 825 minus 625 gives us, 605 gives us 220. Well, that makes sense. So that would be correct. So again, we kind of do opposite of what we're trying to do. Now, what would the debit be? Well, since we've used the supplies, it becomes an expense. So we'll debit supplies expense for 605. Now, how do we know we're going to debit supplies expense other than that's what would happen here? Well, we're increasing our expense. We incurred more expenses. Increasing an expense is an asset. Increases in assets are debit account. So again, thinking about what we already know from the last couple of sections, we can apply it here. So even though I'm telling you that the supplies is a credit, well, why is it supplies a credit other than it's the opposite of it going up? Well, supplies is an asset. That asset has decreased. Decreases in asset is a credit. Okay. Now, again, going back to what we talked about in the last lesson here, notice that the supplies account is a balance sheet account that's decreasing. Notice the expense is an income statement that is increasing. We said that when we do deferrals, the adjusting entry is going to have an increase in the income statement and a decrease in an asset. And that's what we have right here. All right, so let's move on to another example, just again to keep us going and understanding what we're trying to do here. On April 1st, 20X1, Walnut Creek prepaid insurance in the amount of $1,500 for 3 months. The insurance will expire over the months of April, May, and June. At the end of April, 1 month of insurance has expired. Prepare the adjusting entry to record the expiration of the year insurance on April. So again, we got to do a little bit of math here. So $1,500 of insurance, supposed to cover 3 months. So it doesn't tell us how we would distribute that $1,500. The only thing that we can think of is we can distribute them evenly. So if we did that, we would get $1,500 divided by 3 months gives us $500. So it's a safe bet that we can say that $500 of insurance is expired every single month. That would make sense, right? So April has come and gone, and so we need to book an expense for the insurance that we incurred. How much did we incur? $500. Okay, so let me go ahead and give you that original entry. So that original entry to first book the prepaid insurance account probably looks something like this. We would have debited prepaid insurance for $1,500, and we would have credited cash for $1,500 because we prepaid it. So we paid it to the insurance company and they promised to give us insurance for the next 3 months. As time goes on, we've incurred the expense. All right, so $500 of insurance expense has been incurred. The question is, what is that journal entry going to look like? Well, we incurred $500 of expense. So we have more expenses. So expense is an asset. The asset is increasing. If it's increasing, then we are going to debit the account. Well, what account are we going to debit? Well, what caused this expense? Insurance expense caused this expense. So I'm going to debit insurance expense for $500. What about the credit? Well, how did we pay for it? We already paid for it, so we're not going to credit cash, because if we credit cash, we're kind of double dipping here. But where is it housed? Well, it is housed in prepaid insurance. So we're going to move it from prepaid insurance to insurance expense. So we're going to credit prepaid insurance for $500. So it's kind of like a gift card, right? So we go to the insurance company, we give them $1,500, they give us a gift card for $1,500. They will draw on it every month for the insurance that we've incurred during the month. So after 1 month, they take $500 out of that gift card, that insurance gift card, and what's left on the gift card? $1,000. So that's kind of what we're doing here. What should it be? This prepaid insurance balance should be $1,000. So it should be $1,000. How do we get it to $1,000? We need to credit this prepaid insurance $500. Bigger minus smaller gives to bigger side, and in this case, it looks like our journal entry is correct. Okay, so again, we kind of like read through the problem, and the problem tells us that $1,500 over 3 years gives us $500. So that's kind of how much has expired. Now we could go back to kind of what we started with in this lesson and said, okay, what is the account now? So the account is $1,500. What should it be? Well, there's 2 months left, so that'd be $1,000. So 1,500, 1,000. How do we get it to 1,000? We need to book a $500 expense. In this case, debiting insurance expense for $500 and crediting prepaid insurance for $500 as well. Now, one thing to note here is that this $1,000 here is what we would call the carrying values. The carrying value is basically what's left as we go into the next period. So the carrying value of prepaid insurance right now is $1,000. What is that telling me? I've got $1,000 left of insurance expense that has to be incurred before my prepaid insurance gets to zero. So the carrying value is how much we carry an account for at any given time. Since we've incurred $500 of insurance expense, the carrying value of the prepaid insurance is now $1,000 instead of $1,500. So you'll hear more about carrying value throughout not only this section, but throughout your entire course here. So we want to make sure that you understand what it is. It's what we carry that account at any given time. So now we carry it at $1,000. So that is a look at a deferred expense example. Hopefully it's not too confusing. Really, again, what's happening is cash is being paid now. The expense happens later on. As we incur the expense, we're going to have to book the expense. Typically, we're taking out of it of a prepaid to theoretically pay the expense. Cash is not involved after we've paid for it. So once we paid for it, then when we do the adjusting entry, cash isn't involved because we already paid for it and we don't want to have to pay twice. So that's kind of a look at how deferred expenses look like. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.